thereafter. So it still remains to be seen. Obviously, it's a very fluid situation. Does remain to be seen where this ends or where this goes. But for right now, things look to have maybe somewhat stabilized. The market was way up yesterday, then it was way down. Today it's up, and as we speak here on the show. So it's a kind of a day-to-day thing, and you never know what's going to come down the pike.
Yeah, and whether it's creating uncertainty for you or even fear for you, that's the reason we want to dedicate today's Get Ready for the Future show to a discussion about that. And it's a clear discussion based on the data and the facts and not the feelings. And we are pleased to be joined by GenWealth's Chief Investment Officer, Andrew Beatty, on today's show to talk it over. And I want to tell our live audience, so you may be listening on the radio, that would be recorded. If you're listening on podcast, obviously it's recorded, but our live show is happening right now on Facebook and on YouTube, and we want you to be involved in the discussion. So if you want to send a question in while we're talking to Andrew, you can do that. Either just comment in the comments section if you're watching on Facebook, or just shoot us off an email. Go to show@getreadyforthefuture.com. Send it to show@getreadyforthefuture.com. We've got some folks monitoring that email inbox. So if you have something on your mind that you want to talk about, and it really doesn't have to be tariff related, it can be just general market or information or market question if you want. But we're going to dive in with Andrew, who we have here with us today. And thanks for joining us, Andrew. I know you got a busy day. We were just talking about it before we went on the air. Obviously, you're hopping because of everything that's going on in the world around the uncertainty and the market downturn. So we appreciate taking a few minutes out of your day for us today.
Absolutely, guys. Happy to be here. Obviously, not what we want to be discussing, but something that's really important to our clients here.
Okay, well, let's dive in. And when we talk about the perspective on the tariff, the tariff policy, or even the trade policy, I guess, overall, that President Trump is kind of in the middle of, I think the perspective is interesting here because, every president has used tariffs to some degree, but they have been historically pretty low. And now when you talk about what the Trump administration is doing, the new tariff proposals are significantly higher than really any of his predecessors and even his own previous administration. It's broader than those in 2017, I should say. So starting off here, off the top here, can you walk us through the scope of these new tariffs and how they differ from the previous round?
Yeah, sure thing. So I think you hit the nail on the head there. In 2017, the tariffs from the first Trump administration were mostly levied against China. They were very targeted to very few specific industries and specific products there, steel and aluminum being two of the biggest ones and the most notable ones. But I think that the big word there that we need to focus on is, frankly, focused. The tariffs in 2017 were focused. They were strategic. They were very specific. And they were also made in conjunction with tax cuts, some deregulation that was either in place or in process. And those were meant to offset the potential ill effects of the tariff policy to continue really propelling the economy forward. If we cut to today, the tariffs that we have now and that have been put in place since April the 2nd are larger in scope. They cover a wider range of countries, a wider range of products and industry. And frankly, that is most important, along with the fact that the administration right now seems far more committed to maintaining these tariffs, even in the face of pretty dramatic market declines, which is not something that they did in 2017. So this really means that the potential impacts for these tariffs, and remember, we've only really seen the market impact, not the economic impact of these tariffs so far, could be more significant than what we saw in 2017. So it is quite different.
Well, obviously, we've seen this major market hit that has come about with the influx of the tariff policy, but the bond market has remained somewhat stable. What does that tell you, Andrew, about how investors are kind of reacting to this?
Yeah, I think, John, you're exactly right. Although I will say there's a caveat to that, which I'll get into briefly. So far this year, bonds, and we're going to use the Bloomberg U.S. Aggregate Bond Index as a proxy here, has provided some ballast, some stability, as you mentioned. The index is actually up a little over 1% since as of the close yesterday. So that's compared to the S&P, which is down roughly 15% as of the year-to-date period, again, ending on the close of April 8th. What we have seen recently, though, is a dramatic move higher in fixed income yields. U.S. Treasury yields are higher this morning. The 10-year briefly touched 4.5% in overnight trading. And over the past three sessions, again, this is from Friday, April 4th through the close on Tuesday, April 8th, the intermediate to longer term treasuries that we've seen have gone up by more than 50 basis points, or 0.5%. It may not seem like a lot, but in the kind of slow moving, stable bond market, that is an incredible move. Now, right now, we don't think there is a big concern there. There's a bit of a cross current in bond markets. We do see some investors look to bonds for safety, but other investors, and specifically more levered hedge funds, we think are selling some of their most liquid assets, and those would be treasuries, to satisfy margin calls as the equity markets decline. So that's where we're seeing these yield moves. And to remember here, as yields go up on fixed income, that means the prices of those bonds are coming down. So with those cross currents that we're seeing right now, again, we haven't seen a real sell-off as dramatically in the bond markets as we have seen in equity markets. If we get this, I would say, levered de-risking out of the market from the hedge funds and the professional asset managers out there, we do think that treasuries in particular and bonds in general will begin to act as that safe haven asset that we would really expect if we went into a market that is softening, or an economy that is softening in a market that is declining on the equity side.
Talking to Andrew Beatty, GenWealth's Chief Investment Officer, today on the Get Ready for the Future show. And Andrew, you made a great point on that previous question, I thought, when you talked about we've seen the market impact of the new tariff policy, but we have not yet seen economic impact. And, all the data that we see, or most of the data that we see, is the slower growth, but still growth of the economy. So let's kind of dive into the potential economic impact. You hear the president argue, and his administration, and even some economists will say that, hey, the higher tariffs could boost U.S. manufacturing from a jobs perspective, from a production standpoint, and then the increased revenues brought in by the tariffs could raise the revenues, thereby reduce the budget deficit. But let's talk about the other side of that as well. Could those benefits be outweighed by inflation and or slower growth?
Yeah, Scott, I think the answer to that is yes. But there's two real points here, so let's unpack them separately. And I'll kind of start with your second question. Is it likely that higher tariffs could reduce the deficit? And that all really depends on, as you mentioned, the impact of the tariffs economically. And I'm going to quote every economics professor I've ever had, but if all other things are held equal, then higher tariffs would result in increased revenues and a decreasing deficit. However, all things are rarely held equal. And if the tariff results in a negative economic environment, that would likely offset the potential gains from increased tariff revenues. So it's not a given that the tariffs would have that desired effect. The manufacturing question is a bit more difficult. Could tariffs be set high enough to incentivize companies to move manufacturing back to the U.S.? Conceivably, yes. But it takes years likely to increase the manufacturing capacity that would almost certainly increase the cost of manufacturing. It would almost certainly increase the cost of goods and services for consumers in the United States. So that's a big issue. The other issue here is, as we're thinking about this is one administration. The Trump administration is only in office for another 3.5 years. So as they are very committed to this, the next administration may not be. And so if a company has to deploy capital now in order to build out that manufacturing capacity, the environment may change in 3 to 3.5 years. So is that a good spend of capital for those companies if, once those projects become online, they're in a different tariff environment and it's no longer advantageous to be in the U.S.? I'm not saying that that's what's going to happen, but that's the calculus that's going through the executives' minds with all of these companies that could potentially move manufacturing back to the U.S. It's not as simple as tariffs are here, let's move manufacturing. There are a lot of other things that go into that decision.
Let's talk about that inflationary thing. I know that LPL's chief economist compared the current tariff environment to the early days of the pandemic, supply and demand, the supply chain disruptions, things of that nature. Do you think we could see similar inflationary things erupt from this tariff episode that we're going through?
It's a tough question, John. I think that we do believe that one of the byproducts of this tariff environment is likely to be an increase in inflation. I wouldn't necessarily call it a shock, although we have no idea what's really coming. But as businesses, again, adjust to these new trade policies from the Trump administration, we expect shifts in the supply chain. That will probably increase the inflation risk. And although the causes of inflation would be different than the COVID supply disruptions, the effect on consumers is likely to be the same. Now, could that be eventually managed by consumers? Of course. If it's one step up in inflation, that's one thing that people would complain about. It would be noticeable, but eventually consumers would adjust. That's the argument that the White House is making. If, however, it is a sustained grind upwards in inflation, that's where you have real weight placed on the consumer.
Andrew, I know that part of what you do on a daily basis is correspond with and analyze the portfolios of the companies that we employ into our clients' investment portfolios. What are you hearing from them? What are you seeing them do in terms of reaction to this? Are they changing up their allocation mixes? What's going on sort of under the hood of some of the portfolios that you are analyzing on a daily basis?
Yeah, I think it's a great question. And we do talk to fund managers, some of the most sophisticated investors in the world, and they tend to be taking two different tacks, one of which is to de-risk, to go into more cash. We were talking to a fixed income manager earlier this morning who said that they have increased their cash allocation to take risk off the table. That has been one of the approaches. The other approach is the exact opposite. People are plowing into equities because they think that everything is on sale. Now, do we think that that is an appropriate way to react right now? Frankly, we don't. There is a higher probability that there will be a recession this year. So do we think that we've hit the bottom? I'm not sure. We're not in the mood or we're not in the habit of trying to time market bottoms. What we really want to do is to be able to maintain positions in the market with the expectation of volatility and then manage around that volatility. So we want to, again, it's time in the market rather than trying to time the market. And when investors try to time the market, even the most sophisticated investors, they tend to fall all over themselves. So it's not something that we really recommend, and we don't see from many of the fund managers that are out there.
As we kind of explore the market piece to this and the investment piece to this a little further, we've focused, I guess, our discussion on the U.S. markets. Let's talk a little bit about global markets and how they're reacting to these tariffs. For instance, we know Asia saw steepest losses there since 2008. But European leaders appear split on how to respond. So what might this divergence mean for global investors?
Yeah, so this has clearly put a lot of pressure on global equity markets. And most equities have either entered to or are on the cusp of a bear market. Global markets have not been spared in that. Now, they have been holding up better than U.S. equity markets, but they have also sold off by more than 10% over the last month as of the close on April 9th or April 8th. So what's important to remember here is that this pullback is being driven largely by uncertainty surrounding global policy, global growth, and specifically headline fears. We haven't seen, and we mentioned this earlier, any economic data that would indicate a full collapse of growth or a collapse of employment, et cetera. In fact, corporate earnings have yet to really sound the alarm as well. In fact, just this morning on April 9th, Walmart reaffirmed its first quarter sales guidance. That is in spite of the tariffs. So we haven't seen that effect on global markets, global earnings, global employment, et cetera. These are to be expected. Now, I do think there is going to be a difference in performance from country to country, depending on each country's trade relationship with the United States, currency dynamics, other factors. But we, I think, like everyone else, are really trying to understand how each country is going to address this environment, how they're going to address the White House. And there remains a lot of uncertainty again. That uncertainty should begin to come into focus as negotiations begin between the White House and foreign leaders and foreign trade representatives.
Andrew, before we let you go, I want to give you the opportunity just to speak directly to investors. I know you don't give investment advice to individual people, but if you're a long-term investor, how would you be looking at this situation in terms of all the volatility that we've got going on?
Yeah, it's a really good question. And I know giving the advice to remain calm during a severe market downturn like we're in right now seems very out of touch or cliche, but the fact is that it's true. The market is reacting to a lot of headline risk, as we've mentioned, rather than fundamental weakness, which we just discussed. And investors should always look to make decisions based on data rather than headlines, on information rather than fear. The plan that you and your advisor have developed is not based on guesses. It's not based on what the expectation is for tariff negotiations, et cetera. It's not based on the news cycle. It's built around, again, addressing potential volatility, your long-term goals, your risk tolerance, and your income needs. That approach is consistent and should be consistent during rising markets and during declining markets. History really has indicated to us and has shown us that selling during market declines often leads to missing some of the biggest rebounding days in the market. So staying invested is what is very, very clear and very important to investors. I think one of the things that we've looked at is going back to 1990 through the end of 2024, missing just the one best day in the market in a year decreases your annualized return by more than 3%. If you miss two of the best days in the markets, that decreases your annualized return by nearly 6%. So remaining in the market is imperative. That doesn't mean we don't rebalance. It doesn't mean that we don't think about where things are headed. Maybe we build in a little bit more of a buffer. Maybe we take a bit more of a safe haven trade here and there. But the fact is, we shouldn't all run for the exits. And that's where the focusing on information, focusing on data really becomes paramount, especially during periods of volatility like this.
I've always said that it's not a bear market that wrecks your chance at financial independence. It's selling things in a bear market when you shouldn't. And I think that's the mantra that we would just repeat this time, because everybody thinks this time it's different, and it really never is.
Yeah, and the other saying that comes to mind is we always say it's about your economy, not the economy. It's important to have those discussions about where we are in the economic landscape, but certainly, it really is just saying in another way, control what you can control. And I think that's what you're saying there, creating a plan, diversified investment strategy, all-weather plan that really expects times like these. And I think that's the biggest piece here for me. Andrew, again, we're going to let you go. I appreciate your time. We're so glad to have you as GenWealth's Chief Investment Officer. I know I learned something just listening to your feedback today as we talk about the tariff talk that we may be sitting here next month when we have you on again and still talking about, because it's certainly going to dominate headlines.
Absolutely, guys. Thanks so much for having me on today.
Thanks, Andrew. Talk to you soon. So, what's an investor to do? Your investor is to talk to your advisor. That is the key thing here. Do not react emotionally. Act with facts. That's what Andrew says. That's what we've talked about for years, Scott, is that we are literally education driven. And if you understand things that are going on, you're going to make better decisions. If you don't understand what is going on, it's just natural human emotion to react. And oftentimes that reaction is the worst thing that can happen.
Well, if you think about it, John, where an investor's focus tends to be, and I'm going to raise my hand and say my personal investments, my focus goes the same place, right? It's the account value.
That's
it's
right.
the number at the top of the portfolio, right? And you see that number go down and you get nervous. Now, How far it went down depends on how you were invested. Certainly, if you were all in on the market, you've taken double-digit losses since the first of the year. If you have a diversified strategy, more than likely you did not. But still, the focus has to come off of that one number, everything that you've saved, especially as you get closer to and into retirement, and then the focus has to be on income. Now, what do we mean by that? Well, it means a plan for income should expect that overall account value to occasionally dip. Not as much as the overall market does, but it's not always going to go up.
Let's go back to what I said just a few minutes ago. It's not a bear market that kills your chance at financial independence. It's selling things in a bear market. Yeah. So, okay, what's the antidote to that? Well, if you are needing income, the antidote is a nice pool of cash that you can pull from, and then next, fixed income assets that you can pull from while you're waiting on all of this to settle out. Control what you can control, as Scott said. Don't try to control things that you can't. Control what you can control, and that is a well-crafted plan and following the advice that you work out with your advisor.
So we do have a couple of questions that we're going to hit, and I think that where we are right now in the conversation lends itself to dive right into a question from Todd in Sherwood. So we're going to put that up now. My wife and I have around $450,000 in retirement accounts, 401ks and IRAs. We're in our late 50s and would like to retire in the next 10 years. How can we figure out if we've saved enough to retire, and what's a realistic monthly withdrawal rate to ensure we don't run out of money? Todd, thanks very much. So the $450,000 in retirement accounts, that's important. But again, what does it really mean? We just had that discussion, right? It's not about the account value or a number on a statement. It's about income. And he does allude to that in terms of we want to have a realistic monthly withdrawal rate and ensure we don't run out of money. We know that running out of money is a fear that is greater than death for a lot of retirees. We've seen that survey. So this is a common question from a lot of prospective clients that come into our office. So let's talk about how we resolve that. So a lot of this is math, John, right? We talk about the $450,000 in retirement accounts. We're in our late 50s. We want to retire in 10 years. That's the basis of creating a retirement income plan specific to you. So we know what you have now. We know when you want to retire. Some other things that we're going to need to know are your contribution rates, including the match on your employer plan. In other words, what are you adding to that $450,000 over the next 10 years? We need to assign an assumed rate of return to the growth of those assets. And it needs to be modest because we don't need to say we're going to make 12 or 13% over the next 10 years and then not get it because that makes the plan fail. So a modest rate of return gets assigned to the growth of the assets, including the contributions, and you know what your account value could potentially grow to by the time you retire. And I think that's the first piece. You know what that end number is in 10 years when you retire. But then, John, we have to talk about income as well.
That's right. And I think the first thing that you've got to take a look at is what is your situation with Social Security? When are you going to draw it? What is the sequence of that withdrawal strategy? If you're married, then you've got 2 Social Security benefits that you've got to work with. Used to be, everybody said, well, just push it out to 70, you're going to get the biggest benefit. That may or may not be the right strategy because it all really is affected by what you have accumulated elsewhere. And so you begin to assess the Social Security aspect of this, but you also begin to assess your income need. What is it that you have to have every month to pay your bills and live in a decent lifestyle? And when I say that, I want you to think about the essentials of life, not the luxuries, not the nice trips and things of that nature, but food, clothing, transportation, shelter, taxes, insurance. Those things are must-haves. And so it's basically a balancing act. You've got liabilities every month on this side of those things that I just mentioned. And what do you have in terms of assets? And what you want to be able to do is match guaranteed assets, meaning income guaranteed from guaranteed sources, coming in to take care of those certain liabilities that you're going to have every month. Very easy to conceive of that whole idea. And so you want to look at your Social Security and say, okay, does that take care of all those liabilities? In most cases, no. Then you want to say, okay, how much of my assets do I need to commit to something that will give me guaranteed income on top of my Social Security to be sure that that balance sheet is balanced? Once you do that, you take whatever you have left over in your portfolio that wasn't dedicated to the guaranteed income, and then you begin to explore a bucketing strategy that allows you to have discretionary income on top of your survival income that is also inflation adjusted over time. So that's the basic mechanics, Scott, of building that retirement income plan. There's a lot of reverse mathematics that goes into it, a lot of conjecture in terms of what you need versus what you want. All of those things come into play, and that's why sitting down with an advisor, going through what we call the GenWealth Ready to Retire process is so important for near-term retirees.
And that brings us to the second part of his question. What's a realistic monthly withdrawal rate to ensure we don't run out of money? Well, Todd, it is much more complex than that. That is the first piece to answering that question, because if you think about everything we've said, it's really about a tailored income plan for you specifically. So I think too many retirees think about their Social Security separate from the money they're going to pull out of their 401k or their investments. They need to mesh based on the reasons that John just talked about. Guaranteed income for basic expenses, and then desired or discretionary income for the things you want to live out and do in retirement. So if you think about the withdrawal rate that people focus on, the most common one that gets thrown out there is the 4% rule. Maybe you've heard about it. It was kind of tailored back in the 90s, I believe, when interest rates were much higher than they are now. But the thought process is, if you have a balanced portfolio, if your $450,000 grows to $1 million with contributions and growth over the next 10 years, and you take out 4% of that, $40,000 a year, that a diversified portfolio of, let's say, 60% stocks and 40% bonds, that's a safe withdrawal percentage. That's the theory anyway. But if you think about, if you did that last month, right? Even in a 60-40 portfolio, you wouldn't have taken the 15% drop that the S&P 500 has endured since the first of the year, but you would be down. And if you are down over that first year, let's say 10%, which could happen in a diversified portfolio, has recently in the last 3 years, you are now faced with a decision. You have less money in your portfolio, so are you going to continue to take out the 4%, which would now give yourself a pay cut, or are you going to keep taking out the $40,000? You don't really want to give yourself a pay cut, so people are probably going to keep taking the 40, which you've now blown up the 4% rule and taken more than 4%. And if you have another bad year in the market, you see where I'm going with that. That is called sequence of return risk. So it is more than about a simple monthly withdrawal rate, and more about an income plan tailored to you and an investment strategy that goes along with that, John. And we've got a graphic here that shows how the Ready to Retire process here at GenWealth, how we begin to construct that investment strategy.
Yeah, that investment strategy basically is what we call a bucketing strategy. And that bucketing strategy really does lean on, as I was talking about earlier, those conservative investments that you would access early on in your retirement and begin to draw your income from. And as you draw those buckets down, as you see on the graph, those buckets get refilled by the profits that come from the moderate and the growth buckets. Over time, those moderate and growth buckets, you would anticipate good profits from those because they are invested in things that historically have performed pretty well. So if that case repeats itself, then we're going to pull money out of those growth and moderate portfolios and dump it into the conservative portfolio, so you refresh the pool of money that you are pulling from to create the income. Scott, you are always very quick to say that the whole Ready to Retire process is really focused on income. It is income that is the outcome that you're looking for. And so when you design the floor of the retirement strategy that we work with, that's all about income. It's all about guaranteed income. The bucketing strategy is about investments, but it is about creating an investment strategy that is able and capable of producing another stream of income that, albeit discretionary, it is something that people do depend on to increase their income overall for inflation purposes, to be able to take trips and do the things that they want to do in retirement. All of those things play together in the GenWealth Ready to Retire process.
Yeah, and Casey, if we could put that graphic back up real quickly as we get ready to close out for our viewing audience, the bucketing strategy, let's take a look at how that might play out right now, right? So if you think about everything we talked about with the tariff talk and the fears and the uncertainty in the market driving those growth buckets down. So if you're in this bucketing strategy, you might have seen those outer two buckets drop in value for sure, right? If you're in equities right now, equities are down. But if you think about each bucket as, for illustrative purposes here, lasting about 5 years of your retirement, well, then you got 3 buckets ahead of that growth bucket, that first growth bucket. So you're basically selling investments for 15 years before you get to the bucket that is really taken the beating since January. So you have to ask yourself, do you really think that growth bucket, or do you think we're really still going to be talking about tariffs 15 years from now, or the potential impact or the uncertainty around that? It gives time. The time is what can, at least historically, has healed wounds in the market.
Yeah, and if you look at almost any study that is done of the market, Scott, it is that elongation of time that we have created in that bucketing strategy for those equities, because they're the most volatile. So we give them the most time to work themselves out and grow over time. If we know for a fact that any time over 15 years in the market, there's always been a positive return as far as an overall growth strategy is concerned. And so we simply construct this to take what the market gives us and to leave what the market doesn't give us alone until it has time to heal itself.
If you want to know more about the GenWealth Ready to Retire process and building an investment strategy and income plan specific to you so you can focus on your economy and not the economy in these uncertain times, just reach out to us. You can call us. You can call us at 866-653-PLAN. That's 866-653-7526, or you can email us. Just send it to show@getreadyforthefuture.com, and we'll walk you through the next steps. John, time for our final thoughts.
Final thought for me is that if you are a woman and you are at all concerned about the economic environment, you want to go to Enrich. It is a special event that we've got coming up on April 26th at 9 a.m. at the Chenal Event Center. We've got a guest speaker who is an Olympic athlete, very entertaining, but we've got the team from GenWealth. We have several ladies who are investment advisors, and they're there to talk to you about how to build wealth. Wealth is something that everybody is concerned about. It is the threat against wealth that causes people to be concerned about the volatile market. Enrich is a great opportunity for you to learn. Education is the basis of what we do here at GenWealth. You got a great opportunity to do that. You can go to getreadyforthefuture.com/academy to register for Enrich.
Well, in the final seconds that we have left here on the Get Ready for the Future show, first of all, I want to thank GenWealth's Chief Investment Officer, Andrew Beatty, for joining us. A great discussion about the tariffs and the uncertainty around the economic impact that could be imposed there. But again, my final thought is to get a plan. When you focus on your economy and not the economy, times like this, the tumultuous nature of where we are and the uncertainty around it can be calmed because the plan is not emotional. The plan, you stick to it and you diversify with your investment strategy and you build for your financial independence. That is all the time we have for this week's show. A reminder, if you want to get in on the action and ask a question for next week's show, the easiest way to do it is call or text a question to us. 501-381-5228. That number will do either. Call or text us, and we'll see you next time.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.